So let's begin with the big issue. Equities inching back towards a record and a market still looking for a rate cut.
The markets definitely have some upside.
Short-term upside.
The optimal outcome is moderating growth. That's what's happening.
The economy's not that bad. Unemployment's not that bad.
In that environment with lower rates, I think the markets have upside, a significant upside.
The Fed feels like they're ready to step in whenever the trouble emerges.
The markets have anticipated that the Fed is going to come to the rescue.
Financial conditions, by the way, that concerns me because it's both an output and an input into their own reaction function.
We're sort of trading the Fed reaction function here, which can get very circular.
So they're feeding their own reaction function in a circular way.
Because if the market overreacts to what it thinks the Fed is going to do, then maybe the Fed won't do what the market is expecting. So we have this kind of circular thing going on.
So key question, could the Fed really cut rates with stocks at all-time highs? Joining me around the table to discuss, Michael Purves of Weeden, Matthew Hornbach of Morgan Stanley, and Bloomberg's Lisa Abramowicz. So Lisa, let's start right there. Can you imagine them teeing up a rate cut at next week's meeting with the stock market at an all-time high?
The problem is the stock market is pricing in a rate cut. So if they don't cut rates, what will be the reaction from equities, right? I mean, in other words, do they risk disrupting the rally that we've seen and, frankly, curtailing the recovery by not cutting rates? It's sort of counterintuitive. In other words, even if they do cut rates, there might not be a big pop in stocks because stocks have already basically factored that in.
Matt Hornbach?
Yeah, I completely agree with that, Lisa. I think if financial conditions are easy because the market's expecting a rate cut and the Fed sees this, they must know that if they don't deliver, they risk tightening financial conditions, and they have to look themselves in the mirror the next morning and say, is that what we wanted?
Oh, I mean, come on, Matt. Tighten financial conditions by what, though? Equity markets all-time highs, credit spreads are tight-ish again. I mean, what will they tighten by if they don't move in July?
Our estimate is that the rate cut is worth about 25 bips, right, on financial conditions. That's a pretty decent tightening in a very short period of time that could happen if they don't deliver, if, of course, the market's pricing for that.
Michael Purves?
A couple of comments. One, the Fed is fighting two wars on two fronts. One against the White House and another one against the markets. It's almost a new form of bond market vigilantism that's where they're really just almost seeming to be taunting the Fed here. And I think the Fed does have to stand back for a second and realize they have to sort of be the steady course through all of this stuff. One other comment is that the volatility that you had in Q4, right, which clearly did worsen financial conditions, is it really going to be the same replay of that if he doesn't give the cut, right? I would argue that it's not. I think Powell's evolved his articulation and his philosophy a lot over the last 7 or 8 months.
Let's compare and contrast with December. Lisa, weigh in. December was so different. High yield spreads were out near 550 and the primary market totally shut down. I mean, we're not in that position this time around. We're nowhere near it, are we?
No, except on the flip side, we're also not getting inflation, right? I mean, here's sort of the two prongs. No one's talking about financial stability concerns now. I'm going to guess that if this environment persists and the Federal Reserve does cut rates, we are going to be talking about financial stability a whole lot because you are seeing credit spreads come in for 5 straight days, the most since earlier this year, which will foster more borrowing, which we are already seeing. But we are not seeing the inflationary pressure. We're not necessarily seeing job gains accelerating.
Well, the president weighed in on all of this, responding to a Bloomberg opinion piece about high tourism in Europe. Yes, really. And saying the following: this is because the euro and other currencies are devalued against the dollar, putting the US at a big disadvantage. The Fed interest rate way too high, added to ridiculous quantitative tightening. They don't have a clue. The United States has very low inflation. It's a beautiful thing ahead of a US inflation print tomorrow, Matt Hornbach. It is low. The president was out there before pretty much all the economists, as far as I could see, calling for rate cuts, and now everyone's on board.
Well, look, the real problem with low inflation is it does limit the Fed's ability to ease policy with interest rates, okay? Because when the Fed is looking to ease policy, they're looking to do so through the real interest rate. And if you have low inflation, that limits your ability because you have an effective lower bound at zero. Now, unless everybody in the U.S. wants to see a negative deposit rate on their checking accounts, which none of us do, then yes, low inflation is in fact a big problem for the Federal Reserve.